Welcome to The Explainer. Today, I'm stepping into the role of your lead equity analyst to break down the true intrinsic value of Glacier Bancorp, ticker symbol GBCI, using a full suite of professional valuation models. If you want to know what a bank is really worth beneath the surface, you are absolutely in the right place.
All right, let's just get right into it. Currently, Glacier Bancorp is trading at $49.08 a share. But look, as any professional analyst will remind you, price is simply what you pay. Value, that's what you actually get.
So the fundamental question we're tackling today is this. Is that $49.08 price tag a hidden bargain in the financial sector, or is the market just getting a little ahead of itself and overestimating GBCI's true worth?
To figure that out, here's our game plan. First, the Glacier Bancorp mystery. Then we'll run the absolute valuation models, followed by relative valuation benchmarks and an asset-based valuation breakdown. Finally, we'll synthesize it all for our final verdict.
Starting off with part one, the Glacier Bancorp mystery. Let's lay out the core facts of the case.
We're looking at a regional bank with a solid market cap of roughly $6.4 billion. The stock is up about 12% year-to-date, and it's hovering just 9% shy of its 52-week high of $53.99. Honestly, that tells us market sentiment is pretty strong right now. Investors are buying it. But as analysts, we need to dig into the numbers to see exactly why.
Moving on to part two, absolute valuation models. This is where we look inward at the company's raw ability to generate cash for its owners.
We'll start with the classic, the discounted cash flow or DCF model. You know the drill. We project the future cash flows and then discount them back to today's dollars, using a standard discount rate like the weighted average cost of capital. Now here is where things get really wild. We found a massive discrepancy in the data. If we based our DCF strictly on earnings per share, GBCI looks massively overvalued. We get a fair value of just $28.73. But if we pivot and use free cash flow instead, suddenly it looks like an absolute steal at $60.35. Assuming a standard 2 to 3% terminal growth rate, this huge split comes down to one crazy fact. The company's 5-year free cash flow has actually grown over 3%, while its 5-year EPS has shrunk by almost 6%.
Because of that massive split, we desperately need another perspective. Enter the dividend discount model. This one is absolutely crucial for banks, since they traditionally return a ton of capital directly to shareholders.
Looking at the filings, we've got a current dividend yield of 2.69% and a fairly sluggish 5-year compound annual growth rate of just 1.26%. Now, if we apply a sensible cost of equity, basically the minimum return an investor demands for taking on this stock's risk, of around 8 to 10%, well, this model severely struggles to justify that $49 share price on dividends alone. The growth just isn't keeping pace with the required return.
Finally, to round out our absolute checks, we're applying the residual income model. This is a fantastic tool when your DCF results are as fragile or wildly divergent as ours currently are, mostly because it anchors heavily on the company's existing book value, rather than just relying on future growth assumptions.
And wow, does this illustrate a core problem? GBCI's return on equity is currently sitting at just 6.28%. That falls short of even a highly conservative 8% cost of equity assumption. So, in the residual income model, if your ROE is lower than your cost of equity, your residual income is literally negative. This heavily punishes the valuation, dragging it way below the current market price.
All right, let's zoom out. Part 3, relative valuation benchmarks. How does GBCI stack up against its peers in the broader market?
Since standard enterprise value metrics don't really work well for banks, we're relying on PE, price to book, and price to sales. The primary documents don't hand us direct peer multiples on a silver platter, so we're applying standard industry averages for regional banks. And the picture is stark. GBCI is trading at a PE of nearly 23. Its price to book is 1.50, and price to sales is over 4. Across the board, they are trading at a massive premium compared to typical industry benchmarks. The market is clearly pricing in a whole lot of optimism here.
Moving on to part 4, asset-based valuation breakdown. It's time to step away from growth projections and examine the bare metal foundation of this bank.
By taking that price-to-book ratio of 1.50 we just talked about, we can actually reverse engineer the net asset value per share. Just divide the $49.08 market price by 1.50, and we land on a foundational, tangible book value of $32.72 per share. That right there is what the actual assets on the balance sheet are worth today.
Now, the key takeaway here is that while that $32.72 net asset value is obviously a lot lower than the current stock price, the underlying balance sheet is remarkably healthy. They have an incredibly low enterprise value to assets ratio of 0.28, combined with a debt-to-equity ratio of just 0.55. What that tells us is that this foundation is highly stable. It's a conservative, well-capitalized bank. The assets they hold are solid.
Which brings us to our final step, Part 5, synthesizing the final verdict. It's time to bring all this evidence together.
Lining up these models side by side perfectly captures the professional analyst's dilemma. Look at this spread. We've got a highly bearish $28.73 from the EPS-based DCF, all the way up to a bullish $60.35 from the free cash flow DCF. Slap in the middle, we have a hard asset floor of $32.72. Meanwhile, the market is just happily trading away at $49.08.
So let's weigh the strengths and weaknesses here. That massive discrepancy purely stems from GBCI's strong raw cash flow being masked by shrinking earnings. Essentially, if you trust their cash generation, the stock actually looks undervalued. But if you look at the raw earnings, the negative residual income, or how they compare to peers, it looks incredibly expensive. Honestly, the most reliable number we have to lean on is that $32.72 asset-based floor.
Weighing that rock-solid $32.72 asset floor against the tough residual income numbers and that sky-high PE ratio, our final synthesized intrinsic value range sits between $32.72 and roughly $45 per share, with the market currently pricing it at $49.08. Our models point to a slight but very distinct overvaluation right now.
So, the ultimate question this valuation leaves us with, and really, the main thing you should take away from this explainer today, is this. When a company's raw cash flow is strong, but its earnings growth is actually negative, and its returns aren't beating the cost of capital, are you willing to pay a premium just for a stable balance sheet? Let me know what you think, and as always, keep doing your due diligence.